Definition of tax. A tax is a compulsory contribution to the state owed by individuals or entities, which is mandatory based on the law. The main characteristics of a tax are: compulsory. A tax is mandated by law, and there is no option to refuse to pay it. No direct return. The taxpayer does not receive a direct benefit or counter-performance from the state for the tax payment. Used for public interest. The revenue from taxes is used to fund state expenditures, such as infrastructure development, public services, education, health, and other government spending for the prosperity of the people. Types of taxes. Taxes can be classified based on several criteria. 1. Based on the collecting authority. Central government taxes. Taxes collected and managed by the central government through the Directorate General of Taxes, DGT, of the Ministry of Finance. Examples include income tax (PPH), value-added tax (VAT), sales tax on luxury goods (PPNBM), stamp duty, land and building tax (PBB). For specific sectors, forestry, plantations, mining. Regional government taxes. Taxes collected and managed by regional governments, provinces and regencies/cities. The revenue is used to fund regional expenditures. Provincial taxes, motor vehicle tax (PKB), transfer of motor vehicle ownership fee (BBNKB), motor vehicle fuel tax, surface water tax, tobacco tax. Regency/city taxes, hotel tax, restaurant tax, entertainment tax, billboard tax, street lighting tax, parking tax, groundwater tax, non-metallic and rock mineral tax, rural and urban land and building tax, PBBP2. Tax on the acquisition of land and building rights, BPHTB. 2. Based on their nature. Direct taxes. Taxes that must be borne or paid by the taxpayer themselves and cannot be shifted to another party. Examples include income tax, PPH, and land and building tax, PBB. Indirect taxes. Taxes whose burden can be shifted to another party. This tax is paid by the taxpayer to another party, e.g. the seller, who then remits the tax to the state. An example is value-added tax, VAT. 3. Based on the object. Subjective taxes. Taxes where the assessment considers the condition or ability of the taxpayer. An example is income tax, PPH. Objective taxes. Taxes where the assessment is based on the tax object without considering the condition of the taxpayer. Examples are value-added tax, VAT, and sales tax on luxury goods, PPNBM. Elements of taxes. The main elements in the tax system in Indonesia include tax subject, an individual or entity that has the obligation to pay taxes. Tax subjects are divided into domestic tax subjects and foreign tax subjects. Taxpayer, a tax subject who has met the subjective and objective requirements, and is therefore obligated to fulfill their tax obligations. Taxpayers are identified by a Taxpayer Identification Number, NPWP. Tax object, the income, goods or services that are the target of taxation. Examples include income from employment, business profits, or property ownership. Tax rate, the percentage or specific amount used to calculate the amount of tax owed. The amount of this rate is determined by statutory regulations.